Do you know how income tax works in India? It's a crucial part of our financial lives that often gets overlooked. Income tax, in a nutshell, is a percentage of your income that the government collects. This money is then used to fund public services like infrastructure, healthcare, and education. But it's not as simple as it sounds. Taxes in India are bifurcated into two categories: direct and indirect taxes. Direct taxes are the ones you pay directly to the government from your income, like income tax, whereas indirect taxes are levied on goods and services. And then there's the concept of tax slabs. It's a progressive system where the tax rate increases as the taxable amount increases. Understanding these tax slabs is paramount as they determine how much tax you will be liable to pay. This understanding is crucial as it directly impacts your earnings. So let's dive deeper into the world of income tax in India. Have you ever wondered about the difference between the old and new tax regime? Let's dive into the complexities and decipher the two. The old tax regime, a familiar companion to many, is characterized by a plethora of deductions and exemptions. It's a system that rewards taxpayers for certain investments and expenses. For instance, if you were to pay towards life insurance, contribute to Provident Fund, or repay a home loan, the old regime allows you to deduct these from your taxable income. All these deductions and more can significantly reduce your taxable income, hence shrinking your tax liability. Now, let's turn our attention to the new kid on the block, the new tax regime. This regime, introduced in the budget of 2020, is a simplified system with lesser deductions but lower tax rates. It provides a straightforward approach with 7 income slabs and corresponding tax rates. However, it does away with many of the deductions and exemptions available in the old regime. So while you might be paying a lower tax rate under the new regime, you also lose the benefit of reducing your taxable income through various deductions. Here's where it gets interesting. As a taxpayer, you have the choice to opt between the two regimes. Yes, you heard it right. You can choose the one that best suits your financial situation and income structure. If you have a lot of expenses that qualify for deductions under the old regime, it might make sense for you to stick with it. On the other hand, if you don't have many deductions, the new regime with its lower tax rates might be the better option. However, remember, once you make the choice, it's not set in stone. Salaried individuals can switch between the two regimes every year, while those with business income can only switch once. Your choice between the two regimes can significantly affect your tax liability. So, take your time, evaluate your options, and make an informed decision. After all, a penny saved is a penny earned. Are you aware of the important dates in the income tax cycle? The income tax cycle in India is a year-long process beginning on the first day of April and ending on the 31st day of March in the following year. This period is known as the financial year, and it's during this time that you earn income and pay tax on it. The first noteworthy date in the cycle is the 31st day of July. This is the deadline for filing your income tax returns if you're not subject to a financial audit. If you miss this date, don't fret. You can still file a belated return by the 31st day of December, but it's best not to make this a habit as you could face penalties. For those who are subject to a financial audit, the deadline for filing tax returns is on the 30th day of September. If you're a working professional, this date might not apply to you, but it's crucial for businesses and professionals who have to maintain books of accounts. Now, let's move to the final quarter of the financial year. The 15th day of March is another key date, as this is the last day to pay the final installment of advance tax. Advance tax refers to paying a part of your taxes before the end of the financial year. If your tax liability exceeds 10,000 rupees in a year and you don't receive a salary, you're required to pay advance tax. And finally, the last date of the financial year, the 31st day of March, marks the end of the income tax cycle. It's also the last day to file a belated return or revise your income tax return for the previous financial year. Staying aware of these dates can save you from penalties and late fees. So, mark your calendars and keep track of your finances to ensure a smooth and hassle-free income tax cycle. Ever questioned who governs income taxes in India? Well, let's take a moment to pull back the curtain and introduce the primary governing body concerning matters of income tax in India, the Central Board of Direct Taxes, or as it's commonly known, the CBDT. The CBT is the apex body in India for direct taxes, and it comes under the Department of Revenue in the Ministry of Finance. Now you might wonder, why is it called direct taxes? Well, direct taxes are those that individuals and companies pay directly to the government. This includes your income tax, corporate tax, and wealth tax, among others. The CBT's role is multifaceted, and it plays a crucial part in shaping the country's tax policies. It not only administers the direct tax laws through the Income Tax Department, but also provides inputs for policy and planning of direct taxes in India. The CBDT is also responsible for the enforcement of various tax laws and acts as the government's watchdog to ensure compliance. It is the CBDT that takes the lead in investigating tax evasion and conducting raids, something that we often hear about in the news. But beyond these high-profile actions, the CBDT also plays a more subtle yet equally important role in facilitating the smooth functioning of the tax system. For instance, it oversees the functioning of the entire income tax department, ensuring that tax returns are processed and refunds are issued on time. It also handles grievances of taxpayers and works towards making the tax-paying process as smooth and as hassle-free as possible. In essence, the CBDT is like the conductor of an orchestra, coordinating all the different sections, or in this case, the various aspects of the direct tax system, to create a harmonious symphony of operations. It is the guiding force that ensures the effective and efficient administration and collection of direct taxes in India. So, the next time you file your income tax return, remember the Central Board of Direct Taxes. It's the silent machinery working in the background, ensuring that our tax system functions smoothly and effectively. The CBDT plays a crucial role in the administration and collection of direct taxes in India. In the previous explanation, we empowered you with the knowledge of income tax structure and system in India. Now let's move to some income tax planning tips that can help individuals optimize their tax savings. Firstly, utilize the deductions available under Section 80C of the Income Tax Act. You can claim deductions up to 1.5 lakh rupees per financial year by investing in specified financial products like Public Provident Fund, National Savings Certificate, and more. Secondly, consider taking health insurance. Premiums paid for health insurance are eligible for tax deductions under Section 80D. Additionally, don't forget the benefits of house rent allowance or HRA if you live in a rented house. Also, remember the standard deduction of 50,000 rupees for salaried and pensioned individuals. Lastly, if you fall under the new tax regime, focus on efficient budgeting and financial planning as you don't have the cushion of deductions and exemptions. Remember, tax planning is not a one-time activity but a continuous process, and the earlier you start, the better. Armed with these tips and the knowledge from the previous explanation, you should be well equipped to make sound financial decisions that minimize your tax liabilities and maximize your savings. We hope you found this video informative and helpful. If you did, don't forget to hit the like button and subscribe to our channel for more such videos. Remember, understanding and planning for income tax can lead to significant savings, so stay informed, plan ahead, and keep up with the latest changes in tax laws. Thank you for watching and stay tuned for our next video.